Hello again, and welcome to the Wisconsin Lieutenant Governor's Small Business Academy. This hour's session is Future Planning, the Value of Financial Statements. Just a quick reminder that we will have a Q&A at the end of the session. You are free to enter questions into GoToWebinar at any time during this session. And at this time, I would like to turn over the session to our facilitator, Dana Nielsen with Wisconsin Economic Development Corporation, WEDC. Dana.
Thank you, Michael. Hello, everyone. Welcome back to after our break. I am happy to be announcing our 11 o'clock session, Future Planning, the Value of Financial Statements. During this session, the importance of financial statements will be demonstrated. Furthermore, you will learn how you can use your financial statements to grow your business. As Michael mentioned, we'll have an audience Q&A at around 11:40, and I'll aim to give a reminder to start submitting your questions at the 35-minute mark. I'm excited to introduce our speaker, Dave Chappell, a certified mentor at SCORE. Dave Chappell enjoyed a 38-year multidisciplined career at GE Healthcare before retiring in 2011. He has extensive financial leadership experience with global management roles in marketing, engineering, and manufacturing. Dave made a course change to business operations, which included global leadership roles in logistics, sourcing, and international market development. He taught finance and economics at Ottawa University and the University of Wisconsin-Milwaukee. He is also coaching small business owners, including startup companies, as well as ongoing enterprises. Dave earned his Bachelor and Master of Business Administration from the University of Milwaukee. He was also an Introduction to Accounting teaching assistant. Dave is a Vietnam and Cold War Air Force veteran and is a Veterans of Foreign Wars Post Commander. He is a SCORE certified mentor, workshop presenter, and leads the Veteran and Military Outreach Program for the Southeast Wisconsin chapter. Dave and his wife, Sally, recently celebrated their 50th wedding anniversary and have 2 children and 4 grandchildren. He's an avid outdoor enthusiast, enjoying mountaineering, hiking, and biking. Welcome, Dave Chappell, and I will turn it over to you.
Well, thank you very much and good morning. I'm certainly privileged and honored to be here, and I look forward to taking you through the future planning and the value of financial statements. But before I do that, I wanted to just briefly tell you, if you're not familiar with SCORE, what we represent. We are a group of people. I think there's 10,000 mentors throughout the United States. We are overseen by the Small Business Administration and funded by Congress. And our role is to do one-on-one mentoring, providing workshops and planning and other events. So if there's, after this event, and it looks like a great agenda of topics throughout the next couple of days, and you look like you could use some one-on-one or personal mentoring, please just go to our website at www.score.org, and it'll take you through the requesting process to find a mentor, and we will line up someone who can help you out. So given that, let's just proceed, and I think you have to do the slide management, Dana. So next slide, please.
Yes, Dave, we will advance your slides for you. Would it be possible to get your camera for our audience? Otherwise, we'll just advance as is.
I'm not sure what you mean. I'm in the camera. Do you see me?
No, we don't see you. But if it takes too long, we'll just proceed without the camera. That's all right.
Okay. Yeah, I'm not sure what I need to do. It looks like. How's that? There we go. Is that work?
Perfect. Thank you.
All right, just have to click enough buttons. So, all right, I'm glad that was easy. So anyway, so we have a different Dave Chappell show today. The one you may have seen on Netflix is not this one, but anyway, we'll see what we can do with some good information for you. So today we're going to talk about financial statements. And before we get into kind of how you use them, we need to kind of just get grounded on what they are, and then we'll talk a little bit about how they can be used. As luck would have it, I kind of tuned into the session just as Joe was talking about the importance of cash management. So hopefully we're not going to beat that horse to death, but it will emphasize the importance of it. Talk a little bit about business planning, and then we're going over some decisions that you'll have to make and how they affect your business performance. So next slide, please. So there are four financial statements commonly used in the world of financial management: the balance sheet, income statement, shareholder equity, and cash flow. These statements are all different, but they all are linked together, and they all provide an insight into your business that that will help you kind of not just manage your taxes and things like that, but actually manage your business. These are important things to look at and come together when you take a look at the results of your business and moving forward on some of the decisions you might have to make. You'll be grounded in exactly what your business looks like. But it's important that you use them. This is not something that should be farmed out to an accountant. At least you can have the accountant do the work if that's not something you're interested in doing. But at the very least, you need to have an understanding of what's on those numbers and how the decisions you make on a daily basis, a monthly basis, or sometimes even looking forward longer than that, on how they will impact these statements. They're used for just a lot of different people. They're used for banks. They're used to file your taxes. They're used for other investors, and they're used for you to make daily decisions. So the message here is that use these financial statements and keep an eye on what they are and understand the drivers. Next slide, please. So the whole process of a business starts with building a product or procuring a product. What happens after you build it, it goes into inventory, and then it's purchased by a customer. And when it's purchased by a customer, it turns into revenue or sales. And then at the same time, the business will record what we call cost of goods sold, sometimes called COGS. So what we look at here is the elements of this view: sales and cost of sales. Sales are units shipped or sold. Times the price will give you a total sales or revenue number. Total units shipped times the cost of those units will give you the cost of goods sold. The difference between the two are, in this case, gross margin. Margin is probably one of the most important terms that you can use or you'll see in the business. For those of you who watch Shark Tank, one of the first questions they come up with after the presentation is, what are your margins? And this is what they're asking. What are your margins at the gross level after you sell it? In this particular case, you could also look at it in terms of as a percentage. And you can see that the percentage in this case is 50% and 50%. And this just by itself is not particularly useful, but it tells you over time. You can look at this number over a budget or versus competitors or versus other businesses, and you can tell whether or not this business is kind of vibrant. Keeping in mind, you have to have enough margin to cover your overhead, which we'll talk about in a second. So the key to this thing is that the decisions you make are your costs, productivity, and the pricing. All those will determine your revenue and sales and your margins. And production and needs need to include sales and inventory. Typically, if you have a lead time of more than a day to build your product or procure it, then you need to have inventory. By the way, if you're a service business, the fundamentals still kind of work. You won't have inventory and you won't have production, but you could argue that the time spent with your customers providing that service is a cost of sales. So this is something that kind of works across the spectrum of the type of businesses you have. Next slide, please. Operating expenses, sometimes called overhead, are typically portrayed as something that's bad. Everything here is we have low overhead, and overhead is something that we try to avoid. Well, unfortunately, overhead is something, and fixed costs or operating expenses are something that you need to have. It's just a necessity in terms of running your business, but that doesn't mean that they can't be managed. So you need to kind of look at what these costs are, look at them in detail, and see how you need them. But you also have to kind of look at it from the perspective of what does it take? How do I get my product to market? How do I develop my future growth? How do I take care of my by things that like insurance and legal fees and accounting and those kinds of things, and to make sure that I'm running my business efficiently. You'll notice that in this chart we have a year zero, which means that you can have costs before you have sales. So this is an example of how you think about your business looking forward. Year zero is kind of where I am today. Year one is next year, and so forth. But you will have businesses, you will have costs and operating expenses that may or may not come before your sales. So use them, but also use them to make decisions, not just what you need, but where do you add value to your business? I call it the family jewels, and what you should do is, to every extent possible, outsource what you don't need to do in-house. Outsourcing is also not a bad word, especially when it comes to being efficient in your business and allowing you to focus on what's important. Next slide, please. So it all comes together with an income statement. You can see the numbers are the sales minus your cost of goods sold, less operating expenses will give you earnings before taxes and interest. You subtract that from your interest, subtract your interest from that, gives you earnings before taxes. You have to pay taxes, and what's left over is your net income. So it kind of, like as I said before, a couple of key elements of this is that you have to have enough margin to cover your operating expenses. Otherwise, at least long term, you don't have a viable business. You have to keep track of what's in tax, what you pay taxes on, and then what's left over is your net income. Again, you have gross margin we talked about before, but at the end of the day, there's also another margin that people look at a lot, and that's called your profit margin, which is your net income divided by your sales. And in this case, you can see that that's 19.4% growing, but you can also see that over time, as you look at trends, this may not be as good a story as it was. So keep an eye on things, keep an eye on your trends. We'll talk more about that. But this is how kind of an income statement comes together. Next slide, please. Next slide. So net profit, what do you do with it when you're done? Now that you have it, net income can go to two different places. You, as an owner, or if you're a corporation, your stockholders can withdraw it. As a corporation, that's called dividends. As a person, as an individual or an LLC, it's just a withdrawal. If you don't take it out, then it goes to the balance sheet. And we'll talk more about how that works in a second. But the key is that I look at this as profit as being your growth engine. It's when you think about financing your business, either your assets or future cost, you need that income, because the income that you can use to those things then means you have less of a need for outside or external financing. So keep in mind that as you start looking at how much you want to withdraw, there's a couple ways of looking at it. One is that what do you need? You have to buy your groceries and pay your rent, so you may need the money. On the other hand, if you don't, then you might want to leave it in your business and apply those funds and those assets to address future opportunities. So again, sometimes net profit is, they look at, you hear terms in the news, excessive profit and all this other thing. The reality is that without the profit, you can't make a business. Even nonprofits have to make a profit, and that's because of these two things. You need the withdrawal for the reason you're in business, or you need it to apply funds to future opportunities. Next slide, please. So this is kind of a statement that people don't see too much, but it's important, and that's the statement of owner's equity. And what this does, it's the link between the net income statement and the balance sheet. So the way the math works is that you start off with the beginner's owner's equity. In this case, it's 0. And over time, then you add to it your net income, you subtract your withdrawals. The remaining is what they call retained earnings, sort of a logical name for something that you retain in your business. And then it's possible you would have additional contribution, and that gives you your change in your owner's equity. And so it's a kind of a simple chart, but it's that equity that helps finance your asset growth as you follow through these. And it's just, like I said, it's kind of the connection between the income statement and the balance sheet. Next slide, please. Before we get into the balance sheet, I do want to talk a little bit about cash, because cash is a key element of any balance sheet. So I wanted to talk kind of about, the importance of matching inflows and outflows, why you need it to meet your financial obligations, fund assets for working capital. By the way, the definition of that are your assets used on an everyday basis, your receivables and inventory, seasonal fluctuations for those that are businesses that have that kind of a problem, and emergencies and things like that. So it's important to understand cash. It's important to have a plan on how you are going to manage it. And we'll talk more about that in the next couple of slides. Next slide, please. So all businesses have cash requirements. Your operating needs will be curbed. Your operating expenses, which include which include all the elements we talked about before. You have to have operating needs for taxes. Inventory build, you'll need money to pay for any inventory build or any accounts receivable build. Those are called operating needs. And those needs then are something that have to be financed, along with capital expenditures. Capital expenditures are if you want to expand your business, you want to buy office or manufacturing equipment, a truck, a car, computers, all of those things need to be considered capital expenditures, and you need to have funds for them. And then you also have to have requirements, or what we call uses, for your financing obligations. You have to pay for the owner withdrawals, you have to pay interest, and you also may be required to pay debt repayment over time. So between operating needs, capital expenditures, financial obligations, you get your total cash requirements. Next slide, please. So where's the cash going to come from? Cash has, and as I said before, cash can come from your profitability or your sales margin. It can also come from increasing your accounts payable, which sounds a little silly, but if you can ask your suppliers to give you longer terms, like 30 days to 45 days or 60 days, that's basically free financing from your suppliers. The relationship with your suppliers may make a big difference. I know when I did my sourcing role, I was asked our suppliers to extend their terms, which none of them did happily. But it is an option if it's something and you have good relationships with your suppliers. But once you are exceeded, if your requirements exceed your ability to pay from operations, now you have to go outside, and those outside then becomes external investment, or it becomes terms of a loan. But in any case, these have to balance. You have to pay for those requirements. And I think I heard one of the questions in the panel before about equity versus debt. We'll talk more about that a little later too. But it's a key business decision, and those are things that are kind of personal and depending on the opportunities in the business environment you're in. Next slide, please. So the way the thing works is that you have cash in and cash out. Sometimes your cash in exceeds the cash that has your cash requirements. Sometimes it's the other way around. The key though is that you have to manage this business, your cash management on a regular basis. If not weekly, certainly have it managed, if not monthly, and even more before that. And look ahead. Plan operating expenses on what bills you're going to have to pay in the next few days, and as well as your requirements over time, even years, so you can start managing the need on how you're going to finance your opportunities. You need to have cash for emergencies, and those are surprises. Can you imagine getting caught a few years ago when COVID shut the business down? Having a backstop of some cash is important. Having said that, having too much cash is also a problem, because then your cash is not working for you. You need to have cash. You need to be able to have on your balance sheet. Your assets should consist of things that you can sell, things that you can grow your business with. So it is a trade-off between having enough cash and not having too much. It's critical to have good relationships with your banks. Establishing a line of credit is totally and absolutely critical in terms of being able to have access to the cash you need when you need it. Next slide, please. Which leads us to the third statement of cash flow. These are all required. If you're a corporation, these statements are actually required. And what you can see here is that you can see cash from operations is sources and uses. Sources, where's the money coming from? Uses is what I need to my requirements, and what's the cash. In this particular case, you can see after year 0 that there is positive cash flow is the term they use, coming from operations. Cash from investing, same thing. I will not have any sources from investing, at least not usually, but I will have uses. So those numbers are always negative. And then cash from financing may be positive or may be negative depending on whether you're borrowing or paying back. Total cash, change in cash is sort of how those add up. And that's the ending balance. That ending balance on this statement then turns into cash on the balance sheet. So next slide, please. So there's the income statement. You see the cash from before the previous slide and from the previous statement. Accounts receivable and inventory are all what we call current assets. Those are assets that should be consumed within a year, or given the calendar year at least. And those are again, accounts receivable. That's what your customers owe you. Inventory is what you have on hand to sell. So those are the current assets. Longer term, capital equipment and less depreciation. Depreciation is a term that I wish we had a half an hour to talk about, but basically it's an allocation. You do not record the entire amount of your capital equipment on your income statement, but you take a section of it or part of it each year and reduce part of it, and that becomes a depreciation expense, and it reduces the value of your capital equipment on your balance sheet. Total assets then become the sum of the two. Fixed and capital equipment are sometimes called long-term. Subtract from that liabilities, which are your accounts payable. That's what you owe your customer or your suppliers. Bank loan is obvious and what your loans may have come up to. And then owner's equity or contributions of your business. The retained earnings are the money you come from your net income. And those things, it's very important that those things have to balance. Owner assets equals liabilities plus equity. And that's the way of looking at it in terms of that your assets have to be financed. You have to finance from external sources or from internal sources. That balance becomes up to you, as we said before. The other way of looking at it is assets minus liabilities equals your owner's equity. That's, again, some more math. And just think about that with your house. You know, you have your mortgage, and then you have the amount of money that you paid into it to pay off that mortgage. What's left is actually what you really own of that house. And you could use the balance sheet equation to reflect that as well. The other thing that's important to note is that these asset values that you see here are historical and not market value. So you could see the plant equipment here could be $66,000 going up to $80,000. That doesn't necessarily mean if you had to go buy and replace everything, you could do it for that. For those of you who've had to experience some inflation in your business, which is probably everybody, you'll see that those values are probably understated. So just keep in mind that the accounting rules are just not capable of keeping up with market value because they're so volatile. But as you understand the value of this balance sheet, you'll understand that these are not necessarily replacement value. Next slide, please. So we're going to slide into interpreting the financial statements. Excuse me. As I mentioned earlier, the key to understanding them now is to personally review them, not have somebody else, not have your accountant review them, not having your financial person review them. You understand them, and not important just the numbers, but what is it that drives them? Okay, if you're a what drives sales? Well, obviously the amount of the price, but what drives costs of sales? Well, the product cost, your labor costs, what drives some of your overhead, my utility bills, but even customers, how do I look at my market share? How many customers are out there? How many do I have access to? It's very important to understand those drivers, compare them to previous time periods or budgets, and consistent. You can't change. There are sometimes there's flexibility in accounting rules. General GAAP, general accepted accounting principles are what drive them, but there's some flexibility, but not every year. You pick something and you have to be consistent in terms of how you report, not just to keep the rules straight, but also to make sure that they're understandable to you. Next slide, please. I mentioned briefly trends. It's very important to look over time. In this particular case, you can look at and you can see trends by both what's going on with the business, and you can see what's going on with the ratios. And the ratios are the line, and the actual numbers are the bar chart. And so in this case, you can see the sales are growing, but because your margins are going down in terms of a percent, it means that you may have a cost issue, or you may have grown your volume by decreasing your price, which means your margin might go down. But as I said in the starting, you can also take a look at the profit margin, and you have the same phenomenon, which means that I could also have some situation where my costs are growing faster. When you see that the yellow or the gray lines going down, that usually means that your costs are going up faster than your sales are. And so now it's a matter of trying to figure out whether that's acceptable to you. Maybe the market has changed where you have to have lower prices to compete. And so now you have to decide, if you can't raise your prices, can I control my costs, or can I lower my prices some more to even get more volume? There are all kinds of decisions that have to be made. But unless you understand kind of the direction that your business is going, looking at the top line and the bottom line, you can't kind of manage this. In addition, is this a trend, or is this a one-time year? Maybe I look at year 4, maybe they'll have recovered. And so you have to kind of understand where you're going. But more importantly, use this stuff like this to make sure that you can make decisions on how you react to it. Either live with it or try to change it to make your business more profitable, more efficient, and so forth. Next slide, please. There's a lot of numbers, a lot of colors on this chart, so I won't spend a whole lot of time on it, other than to tell you that the variance analysis is taking a look at your actual expenditures, comparing it to a budget, or budget to compare it to last year. Those differences between budget and last year are called variances. And so what you can look at them in terms of, in this case, the green is that your variances are better. The red are your variances are getting worse or deteriorating. And immediately when you do something like this, you can focus on what's going on with your business and start to dig a little deeper to figure out how you could get them better. In this case, you have a strong sales performance. Product costs did improve, but not as much as expected because it's different to budget. So looking at it from those kind of angles, you can kind of see what's going on. And you can kind of see your total cost, your net income, where it is in your variances. You can do graphs. You don't have to do all that. But take a look at what the key here is that what is your performance versus what you expected? In other words, the budget, or what is it last year? So am I getting better from last year? Getting worse? Am I doing as well, or am I doing not as well as I expected compared to my budget? So understanding that baseline and what's happening, again, at the risk of beating this to death, is to understand those drivers and set those metrics. Once you have an understanding of what those drivers are, start measuring and monitoring the drivers. Next slide, please. There are all kinds of ratios. We're not going to go through them today, but I'm hoping you have this availability for these slides that you can kind of look at them. But profitability, liquidity, asset utilization, and financial structure are all measured and understood by making some comparisons. We talked about the margin percentages before, but there's also a return on your assets. How much is my net income compared to my assets? Or how's my return on my equity? Those are basically return on your on how well your assets are working for you or how well you're doing on your investment. The last one, return on equity, is not unlike you go put your money in the bank and you put $100,000 in the bank and you get $100 of interest. Now you know that return on that investment or equity in this case is 10%. Liquidity is trying to measure and understand whether or not you can pay your bills. It's really that simple. Current ratio is your current assets over your current liabilities. And typically that includes cash, or you can have a quick ratio which subtracts inventory. The theory of that is that inventory moves more slowly than the rest of your assets, or at least the rest of your current assets. The key is that, again, watch this one, just because that number, it would seem logical that the higher the better, but not necessarily. You don't want assets that you're not using. And so make sure that you don't have too much cash, for example, that even though it kind of looks good here in this ratio, it may not be efficient for your business. Asset utilization, turnover ratios, those are a little bit more complicated in terms of how they're used, but fundamentally, as you look at your number of days, and that's called turnover, and or number of days in how much inventory. So in this case, your assets, it's a two-step approach where your turnover is just dividing your sales by your receivables. So in other words, I have 6 times more sales in receivables, and if you divide that into 365, you find that 60 days. So that's a good thing if your terms are 60 days or higher. If you have 30-day terms and your average is 60, then you have a problem. Inventory, similar. You look at those ratios. Cost of goods sold, and in this case, it shows you have 48 days of inventory. Turnover is how many times you can sell that product from your inventory. In this case, it's 7.5, and that's typically pretty good. But you may have a business that needs it faster, or you can get away with a business that's slower. Financial structure is just how you've organized your business financially with liabilities and debt, and you can kind of see the ratio here is 50-50 in this example, but the decisions you make will be reflected in those ratios. So that's that. So if you could, next slide, please. Now, as we go into financial planning, now that we have kind of grounded with the numbers and how to interpret those on a regular basis, as you start looking ahead, whether you're just ready to start your business today and moving ahead in the next years, or if you already got a business, you should still be using this structure. And understand that financial planning really starts with a business model. And so, what does your business model look like? There are ways to do that if you haven't. We have a business model canvas that will take you through that. But understanding what is your business, how do you go to market, what products are you going to have, who are your customers, who are your partners? Very important. And what's your value proposition? Why would somebody want to buy from me? How am I going to get the product or service to my customers? All those things are something that have to be looked at in terms of your business model. And it's important to spend as much time on the business model, even if you have an ongoing business. We used to call it strategic planning in my world. They call it business model management here, which is I like better. So understand that model and understand your competitors' models. How do they do it? Things like that. So there are a lot of differences in how we can look at that business model. But once that's in place and once your business is ongoing, the financial planning is nothing more than a numerical display of that business model. It's your report card on how well that business model is working. And that's an important thing to understand looking ahead and looking back to see how well things are going and what your plans are moving forward. They also have to connect your business plan. That has to have assumptions to it that have to make sense. The panel before me, I just heard one of the panelists talk about how it's important to have the dots connected, I think he said, in terms of how the business model actually does turn into a financial plan that makes sense to you. So let's go to the next slide and we'll see how this might work.
And I'll take this slide transition to remind everyone to submit their questions for Q&A.
Yes, please do that. So the business planning cycle, it starts off with the business plan, which we talked about. That pretty much establishes the business model, the direction you want to go. It's not just kind of the plan, the vision. How are you going to execute? How are you going to make that happen? making sure you understand the elements of what that takes. People think about sales and I got this great product, but if you forget on how to get it to your customers, do you want to do it online? Do you want to have a storefront? What are those kinds of things that have to happen? So far, it's a regular monitoring. We talked about that. It starts off with that business plan, multiple visions or multiple years, strategic vision. You create a budget for a fixed period of time. Again, measurable time segments, so you can kind of look at it with that variance analysis I talked about. A forecast. The budget is done annually by definition. Forecast is what do I look at regularly, and then measure the results. Measure the results against forecast, budget, previous year. The primary example of how this would work is you set up. Think about this being in 2020 when you set up your annual budget for 2021, and you had all these plans in place, and then they shut the world down with COVID. Now, how are you going to manage your business? Now you have to forecast. What are the impact of that going to be to my business? How do I change what I'm doing? And now I operate not to a budget that is no longer relevant, but to a current forecast that is more relevant and continually be changing. And then again, measure those results and then take action accordingly. Next slide, please. So these elements might look a little familiar to you: the budget requirements, planning requirements, income statement, decisions you have to make. Okay, we'll talk a little bit more in detail later. Pricing, product cost, my volume. What are my assumptions about how many volume? What can I sell at this price? What are my ongoing expenses? New initiatives. What opportunities do I have? Looking at this in segments, especially important. You have a seasonal business. Think about your business if you sell lawnmowers, or if you're a landscaper. You know, well, how do I manage my business if I can't mow the lawn in the winter? What are those impacts? Equity statement. Now I understand. Now that I have this business, and I'm going to develop what they call a pro forma income statement, which means looking ahead. What are my profit? How much do I think I can take off? What am I going to need to continue to finance my business? Moving into the balance sheet, my working capital. Again, working capital or current assets like inventory and receivables offset by accounts payable. My terms. Can I get more sales if I offer 60-day terms or 90-day terms? How much inventory do I need? A lot of that becomes on how long it takes you to build your product or cycle time. Sometimes if you're selling orange juice, now all of a sudden you better not have very much inventory. You have to, using the terms of the ratio, turning it over quickly. Terms of your vendors, and then capacity needs to kind of identify what capital needs you might have. And then where's the money going to come from? Am I going to get it from my business? Am I going to get it from external financing? And I have to look at it both short-term and long-term. So again, you can use these things to manage your resources, to control your business. And oh, by the way, if you use them as part of your compensation plan, you can use them for employee motivation to make sure that they're on the same page that you are, working towards the same goals. Next slide, please. You know, one of the things that you have to always have in the back of your mind as you start doing business planning are business risks. The systemic risks or systematic risk are risks that are uncontrollable. COVID, for example, is the poster child of this. Unsystematic risk are those that are controllable that might just apply to your business. Examples of the unsystematic risk might be if you have a machine that is unique to your product, might go down for a while. You have a disruption in your supply chain, those kinds of things that may not affect the whole world, but it certainly affects you. So you have to be able to kind of manage both of those things. Considering that the types of risk, you have strategic risk, looking at who your competitors are, who your customers are, what's changing in technology. You know, think about cell phones and land phones and typewriters and all those things over time that have done that. What's happening to the economy right now? Strategic risk might include inflation, which then turns into a financial risk of interest rates, foreign exchange rates. I just read the other day that the dollar was strengthening so much against the yen, which means that if you're trying to sell in Japan, you may have your products should be very expensive to them. Operational, human error, technology and risk. We just talked about some of those. Capacity constraints and quality. I can't emphasize quality enough. You really need to make sure that your business is on a solid footing is managing and measuring your quality, because that can turn off a customer faster than you can imagine. And it's not just the quality of your product, it's the quality of your service, it's the quality of your distribution, it's the quality of all of those things that have to happen. Compliance, make sure. I came from a healthcare business. You imagine how much money we had to spend on our FDA requirements, but others have too. OSHA, the EPA, they're changing the rules all the time. Local codes, if you're a restaurant, just think about what has to happen there. So you also have to manage your compliance and understand that if you are found in violation of some of those requirements, what it can do to your business. So managing risk is really important. And we'll talk more about that in the next slide. Next slide, please. Yeah, there we go. So managing the risks, I think the key is that make decisions. As you make your decisions and you look pro forma ahead, do what I call a risk-adjusted return. Look at a sensitivity analysis where you might say, okay, I think I'm going to sell 100 a month, but what if I sell 75? And run the numbers accordingly, and you might find that risk that is not, you might not want to take that risk, so you might want to make some changes. Or you might say, okay, what if I could sell 110 a month? Am I structured to be able to meet that demand? And so manage it that way. Diversification is your plan. So your friend, I say that in the sense that if you have options to your customers with alternate products, alternate markets, then you can offset some of the risks. But the key is to stay on top of your business. Just always be in tune to it. Monitor your supply chain. Feel flexibility. Maybe not have all your important suppliers or products needs for your inventory to come from one place. Again, with forecasts and a strong balance sheet, make sure you're not overly leveraged with your debt, and have adequate cash reserve. And oh, by the way, don't forget your insurance. Next slide, please. So as you make decisions, we're just going to go a couple of them today on some of the things, but keep in mind, as you start looking at some of the decisions you have to be made, they're made in the context of kind of how you view your numbers in terms of how understanding them, what your risk tolerance is, what's going on in the market, interest rates today. It's harder to make decisions today because you have fewer options with higher interest rates, and regulatory and tax compliance are all things that have to be put into place. And I use these, as I said, a context as you make some of the decisions that you're going to make moving forward. Next slide, please. And I'm going to wrap this up as quickly as I can so we have time for questions. Business decision on pricing. I think the key element to this chart is understand that pricing and your ability to have it be successful is how sensitive your product is, the volume is to price. So for example, if you have gasoline is not very sensitive to price because you still have to buy, you have to get your kids to school, you have to get to work, but steak and high priced meat might be sensitive to price if they have other options. So understand your competition, differentiate your product, making sure that people understand that your quality is better or your product features are better. And that includes a total buying experience. And if you have all that, you can outdo your competition. Now you have more pricing flexibility. Next slide, please. You have to make decisions on production. The key there is to understand that you can only increase production and sales to a point and continue to make profit. Eventually, you get to a point where your cost structure, your capacity can no longer support the higher volume. And now your costs go up faster than your price and your volume. And now all of a sudden your profit goes down. So understanding your cost structure, understanding the sensitivity of price will help you make good decisions in terms of your production. Next slide, please. Business investment. Looking ahead, you're going to have to decide on whether or not that investment is worthwhile. And the key to do that is to look at it from a rate of return, making sure that's positive, or understanding payback, which is fundamentally a way to tell you how long it will take you to pay back that investment. There are a lot of more structured and sophisticated ways of looking at that. Just ask any finance major. But for right now, especially for smaller businesses, looking at these two is primarily a good way of kind of understanding whether this is a good project. The key is that look forward. Anything that you look behind or where you are today is irrelevant. The only cost that you want to look at, and the only revenues you want to look at or benefits you want to look at, is the incremental or the incremental piece. And let's go to the next slide so we can get some questions. I guess that was the last slide. So I guess we have a few minutes for questions. So thank you for your attention, and thank you for attending. And any other questions?
Thank you, Dave. We really appreciate it. There are some audience questions. The first one, are there any other considerations, and this came in at 11:19, just to contextualize in your presentation. Are there any other considerations if your business is providing a service rather than a product?
It's a little different for service businesses, but not fundamentally so. So you don't have to worry about inventory. But I did, when I first made a presentation like this, there was some consideration as to whether or not the time that was put in, and it was an organization that did consulting work, and they were trying to decide whether or not the consultants were a cost of goods sold or whether they were fixed costs in their salaries. And so it's a little bit on understanding the behavior. So if you have 10 people on staff and they're either consulting or grooming dogs, it doesn't matter. If they're there all the time, then you may look at them as more of a fixed cost, and you won't have any variable cost or cost of goods sold. On the other hand, if the behavior of that is they come in when you get busy, now all of a sudden it looks like it might be a cost that varies or be a cost of sales. Either way, understanding probably so you still have to understand the overhead, the support network that you need for the consulting or for the service, but at the same time you also need to kind of understand exactly how these people are behaving, because you also have to make decisions on how many people you want to have in staff. If you're kind of just by yourself, then that doesn't matter a whole lot. The other thing is that, by the way, is if it's your own business, you should pay yourself a salary. And so if you're kind of a small business and you're just taking the withdrawals, I think you're kind of missing an opportunity to understand your business in terms of how it works against your competition. So hopefully that helps.
Okay. Question number 2 from the audience. Hiring bookkeepers and/or a CPA is important, but also expensive. How might a small business determine pricing and competency of the firm's accounting services?
Well, I think I think you have to interview them and experience. I think one of the things you might want to look at is if you're a smaller business, invest in QuickBooks or something like that, and take the time to understand how they work. Then it's sort of outsourced, but QuickBooks can do some things, and then go to your accounting firm to have them kind of put them all together in a way that will satisfy your taxes. Maybe between QuickBooks and/or a CPA, or just maybe take a couple classes and learn to do some of the stuff that's in this slide. You don't have to have an accountant to do all of this stuff, but maybe a quick look every once in a while with some quick ratios or some quick looks at it. Will do what you can, because I agree that they can be expensive, but I would say developing a relationship with an accountant is almost as important as with a bank, so that you can call them up on a regular basis and just kick some things around, and this just develop that relationship. Go out and check them out, and there are a lot of accountants out there that service small businesses, and hopefully you can come up with a price that makes sense for you.
Thank you, Dave. And the final question that I think we'll be able to take this morning: how long is your mentorship program? I assume that's SCORE.
Yeah, it's as long as you need us. And oh, by the way, I should have mentioned it. The cost is pretty good too. It's free. So as long as you have questions or as long as you have need, our mentors will be there for you.
Well, that wraps up our time available for questions. Dana, Dave, any last thoughts for our audience?
No, I think I just appreciate the attention and the opportunity to present this, and feel free to reach out to us or to me if there's anything we can do to help you with your business.
Yeah, no last word for me other than thank you, Dave, for joining us today and sharing your expertise with us.
You're welcome.